Here again with Smart System. In our last lesson, we looked at the existing home sales number and what this tells us about not only the housing market, but about the economy as a whole. In today's lesson, we're going to look at an indicator, which is a survey of consumer opinion on the economy, which tends to lead the business cycle by several months, called the Consumer Confidence Index. So let's get started. The Consumer Confidence Index is released at 10 o'clock a.m. Eastern Standard Time on the last Tuesday of each month, and this number is a monthly survey of over 5,000 households, the purpose of which is to gauge the financial health, spending power and confidence of the average consumer. The Consumer Confidence Index contains 3 separate headline numbers, which are the index of consumer sentiment, or in other words, how people feel about their current financial conditions, the current economic conditions number, how people feel about current economic conditions in general, and then number 3 here, the index of consumer expectations, which is how people foresee things are gonna be in 6 months' time. So the difference here, the third one should be pretty obvious, but the difference between the first and the second here is that a lot of times people be doing well themselves. They feel fine about their current financial situation, but they feel that the overall economy are not doing so well, and so that's the difference between those two, which is sometimes some confusion there. The consumer is gonna normally adjust spending habits based on how optimistic or pessimistic they are about the economy. So they're gonna pull back when they feel things are souring to save more, or vice versa. So you can see here we give us some optimism, and you're gonna see consumer spending normally rise as a result of that optimism. And if you have pessimism, you're gonna see consumer spending normally fall as a result of that. And as we've learned it in previous lessons, as private consumption, consumer spending is such a large part of the economy. And because this indicator gives a good insight into this segment, it's closely watched by market participants and can be very market moving, especially if it comes in at off expectations. It's important to understand here, however, that this is a survey based on people's opinion. And unlike most of the other indicators we've studied up to this point, the individual survey are not likely basing their opinions on hard data. It's for this reason that consumer paying can be easily swayed by things such as short-term spikes and gas prices, and why most market participants will use 3 to 6 month moving average of the data to get a better picture of the trends and consumer thinking, cause this number can be fairly volatile depending on what's happening in the short term. So as with the other leading indicators we've studied that thus far, the Consumer Sentiment Index component, which is the leading component of this indicator, because that's leading, it makes it all that much more important to the market. As with all the other indicators that we've studied up to this point, the best way to get a feel for how the market's gonna react to this number under different scenarios is to follow the indicator in real time. So with this in mind, as with the other indicators as well. So that's our lesson for today. And our next lesson, we're going to wrap up our discussion on economic indicators, which gonna close up this section of fundamental analysis with a look at the Conference Board's index of leading economic indicator. So definitely check that one out, because this one combines a bunch of the stuff that we've learned up to this point on the indicator side of things into one indicator. It's pretty interesting one. So we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to post them in the comments section. And good luck with your trading. Have a great day.